Good afternoon, everybody. My name is Joe Werther, and I'm senior lecturer here at Georgia Southwestern State University in accounting. And this afternoon, I want to talk about Chapter 15. I know you have a test this coming weekend, and I thought I might go over some concepts in Chapter 15 that were not in Chapter 14. There are a lot of similarities between the two chapters, but I have noted here two differences. A new account called manufacturing overhead and a predetermined overhead rate that you have to figure out. Now, in Chapter 14, the problems in the book just told you what overhead was. In other words, you might have to add up utilities, rent in the factory, utilities in the factory, insurance in the factory, indirect labor, indirect materials. You had to add all those together, and that gave you overhead. But about 10 years ago, the accounting profession came up with a new way to allocate overhead. Actually, it was longer than 10 years ago. We've been doing this for a while. In fact, when I worked in this 25 years ago, we were figuring out overhead this way. But what we do is we estimate for the upcoming year the amount of overhead that we're going to incur. And we call that estimated overhead. Okay? We think we're going to have this much overhead for the upcoming year. And usually this takes place the last 3 months of the prior year for the upcoming year. Okay? So we come up with this amount of estimated overhead, and then we look at our business, and if we are a labor-intensive type business where we have a lot of employees working, we will use as a denominator estimated direct labor hours or direct labor cost. Okay? If we're that type of a company. Now, if we're a company that is more robotic and has more machines working, and we don't have the manpower that we used to have, we've outsourced a lot of our manpower, laid a lot of manpower off, then we will use estimated machine hours. Estimated machine hours. And what we call this denominator here is our base, our allocation base. And the thing to remember when you're putting your predetermined overhead rate together, you need to look for the words estimated, okay? Because it's always estimated overhead over an estimated base that gives you this predetermined overhead rate, okay? So once we get this predetermined overhead rate, then we take this rate, and this is important now, you have to look at the base you used, okay? Now let's say we use direct labor hours as our base. Well, we take this rate and we multiply that times our actual base, and that gives us what we call applied overhead. Applied overhead. Okay, so again, the rate that we come up with, the predetermined overhead rate, multiplied times the actual base, okay? You have to look at what you used as a denominator here and say, for example, we used estimated direct labor hours. Then we got to go to look in the problem for the actual direct labor hours that were used on the job. And we take this rate and we multiply it times that actual, so let's say they were directly over hours, and we come up with an amount called applied overhead. And what we do with the applied overhead, we debit work in process, applied overhead, okay, and we credit the manufacturing overhead account. Okay? Okay, that's the entry we make. We debit work in process, we credit the manufacturing overhead account. Now, you have to remember that when you're applying overhead to work in process, you're always going to credit manufacturing overhead. Now, what's the rest that goes in work in process? The same things you learned in chapter 14. Direct materials, direct labor, and applied overhead. The only difference from this chapter compared to chapter 14, now we're applying overhead, where in chapter 14, we were just given an overhead amount. And we do this at the beginning of the year because for a lot of these jobs that we do and we complete, we will not have the actual overhead cost in till the next month. And as we get these jobs completed in this month, we need to get those jobs out in inventory and get them sold. I mean, we're in a business of selling goods that we're completing. Okay, so we need to get overhead applied to the job that we're working on as soon as we can, because if we don't, we're going to undercost our job. Now, in the meantime, this manufacturing overhead account on the left side keeps track of all the actual overhead costs that come in. For example, indirect labor, indirect materials, rent, utilities in the plant, insurance costs in the plant, taxes in the plant, all those actual overhead costs that come in either this month or next month all get debited to the manufacturing overhead account. So what you have is you have all the applied overhead on the right side and all the actual overhead on the left side. And you can always look at your overhead account and say, right side's applied, left side's actual. So that's a big difference, from chapter 15 to chapter 14. Everything else is pretty much the same. Now, there's only one more step. At the end of the accounting period, we add up all our applied amounts and all our actual overhead amounts. And I'm going to put in a couple random numbers just to show you what you do. Let's say all your applied overhead to all your jobs throughout the months was 150. And let's say your actual overhead costs that came in throughout the months were 200. So what did you do? You under-applied overhead. You didn't put enough cost in the product. You should have put 200 in, but because you wanted to get the product done and get it out in the warehouse and sell it, you only put $150 in. So what are we going to do? Okay, here's what we're going to do. The side that's always smaller, you make it equal to the side that's larger. So we're going to credit manufacturing overhead, draw a line, and now both sides are 200, and that zeroes that account out. In other words, we're going to kind of close that account out. That's a temporary account that just keeps track of all the actual overhead costs and all the applied overhead costs. Well, when we credit something, we have to debit something. So what are we going to debit? We're going to debit an account called cost of goods sold for $50. And when we debit cost of goods sold for $50, we're actually increasing the cost of that product that we're selling. So when it looked like we were under costing the product, we made a comparison and we saw where the actual was larger than what we applied, and we've got to get to the actual because we're trying to get costs as close as possible to the actual cost. So we credited applied overhead, which we always will. Well, we will if our total applied is less than our actual, okay? So we credited applied overhead and we debited cost of goods sold to increase the cost of goods sold. And now we have the right cost in our product. And when we sell our product, the gross profit or gross margin it should be real close or right on to if it was almost perfect cost. Now, if you over apply, in other words, if this side is 200 and this side is 150, then we would add 50 on the debit side of the manufacturing overhead account. And we come up here and we credit 50 to cost of goods sold. In other words, we applied too much cost, so we're going to come up here and we're going to credit cost of goods sold, and we're going to reduce the actual cost of goods sold to get it more in line to what the actual total product cost should be. Now, you can look here on page 810, shows you the predetermined overhead rate, how to calculate that. And a good page to look at is page 815. It shows you the complete flow of cost through all the T accounts, starting with raw materials to work in process to finished goods to cost of goods sold. And then it shows you that manufacturing overhead account that I'm talking about right here that houses all the actual overhead costs and all the applied overhead costs that you did during the month, okay? The applied would be what goes to the job to get the job finished. When the actual overhead numbers come in, you compare what you applied to what actually happened, and the difference either increases cost of goods sold or reduces cost of goods sold. And that's the main concept that's in chapter 15 compared to chapter 14. Everything is the same. I mean, it's called job order costing, which, by the way, job order costing deals with specific jobs. For example, your heart surgery will be different than my heart surgery, okay? Or the next person's heart surgery. Depending on how much, what needs to be done and what drugs are administered, all that would be different, okay? So a surgery would be a job order costed job, where let's say you're making Coca-Cola or Pepsi and everything's the same. It's just one big vat of regular Pepsi. That would be what we call a process costing system. And we're not talking about process costing in this chapter. We're talking about job order costing, okay? So just remember, job order costing has to do with each job is specific. And if you study the diagram on page 815 and you go through the multiple choice questions at least 3 times and the self-tests at the end of chapter 15, you should be in pretty decent shape for the test. But just remember, the whole flow is raw materials to work in process to finished goods to cost of goods sold. And the last thing you do is you have this manufacturing overhead account that has all your actual numbers on the left and all your applied numbers on the right. You add both sides up. You compare the numbers, the totals, okay? One side is going to be smaller than the other. If applied is smaller, you make it the same as the actual, and you come up here, you credit applied, and you come up here and you debit cost of goods sold. Okay? If applied is larger, you make the actual the same amount as applied, and you come up and you credit cost of goods sold. You're either increasing cost of goods sold, which is your main expense, main product expense, or you're decreasing cost of goods sold. And that's the big difference in chapter 15 when I looked at chapter 14. Now, you've got to know, though, you've got to know your overhead costs, like I stated in my last chapter summary. Please, go to chapter 14. Know that direct materials, direct labor, and manufacturing overhead, which are a bunch of different costs, are what we call the product cost or the manufacturing cost. Okay? And of course, usually you're going to have some beginning work in process and some ending work in process. So what's the cost of goods manufactured? It's the amount that gets credited to work in process at the end of the period or whenever and gets debited to finished goods. Now, if you know these concepts and you do the multiple choice questions, I'd say at least 3 times, you should be good to go for the exam. Thank you very much, and you'll be seeing me for chapter 17. Probably the next video I'll do is I'll do an activity-based cost problem in chapter 17. Thank you very much.